All right, the market's getting tight out there, and I do believe that some people are starting to feel the pressure. Welcome to Growing the Money. My name is Rich Lennon, and today we are going to talk about the increasing pressures on the market and what that means for your borrower and what it means for you as the lender as we try to navigate this difficult time in the real estate market. My name is Rich Lennon. We talk about growing the money every morning from 9 to 9:10. And yeah, we're going to go get at it today. All right, I'm going to have my coffee. Hope everybody's having a great day. All right, so today I want to talk about what's going on in the market and that we have a significant amount of days on the market that are increasing. And that might not be for every home because I keep hearing from every realtor that is out there on social media land that if you have a great house and a great market, then this market is not slow, that there are plenty of offers. The problem with that is a lot of our flippers, a lot of the people that borrow the money from us, they tend to be in these weird houses. They are buying a distressed house to begin with, and it's not always in a perfect neighborhood. They are sometimes in a sub-secondary neighborhood, and thus a lot of our flippers that are in that because we want to lend our money below the median. So we want to be in the bottom part of the market. It's what makes the most sense for the flipper, and it's what makes the most sense for us as a lender. But when times get tough and the market gets slow, we get disproportionately impacted more than a regular market. Because it's correct, if you have a great house in a great neighborhood, it's easy to sell all the time, every time. But that is not always the case with our flippers. So I want to talk about some of the things that are going on. So I'm going over my numbers and I'm looking at the fact that now my defaults are at about 50% of my portfolio. Traditionally, I lend money for 6 months and my average loan is about 8.5 months. So what that means is that going into default happens all the time in my lending model. So it by itself is not something to be concerned about because we're allowing the note to go into default as a strategy. So but the concern is that it's normally about 25% of my portfolio is in default. And now it's up to 50%. And the reason is because days on market are increasing and our flippers are trying to hold on to properties and trying to get a valuation that they think they can get, and that valuation might not be a reasonable one in the amount of time that they have to get the money back. And this is an important situation where you, as the lender, need to begin to put a little bit of pressure on your borrowers to move properties at a valuation that they might not want. They might want $400,000 for that property, but you need to begin to put a little bit of pressure on them to maybe sell it at 380 or 390 and to exit the property so that your risk is not realized. And this is a great example of why we only lend for 6 month cycles and we don't lend for 1 year, because you can see something going on in the market and you can start to make adjustments at 6 months rather than having to wait the full 12 months to figure out what you're going to do and how to extricate yourself from the situation. I'm going to give you an example of a property that I'm lending on right now and what's going on. So I have someone who borrowed money. It's local here in Richmond. They borrowed money for a property, and the total amount that they borrowed was about $300,000. So the total expense for the project of purchased the property and then I did the renovation for that property is around $330,000. We require 10% down. Now, I don't traditionally take interest along the way. I do that because I have a fractionalized note, and sometimes the administrative process of that disbursement can become administratively burdensome. So, as a strategy, I typically do not accept or do not require interest payments to be made. Now that projects are going on longer, we're seeing the impact of not taking those payments. And that impact is greater stress and greater risk on the loans that I have out there. So the longer the loans stay out there, the more money someone owes me, the greater my risk. Don't worry, Rich isn't in trouble. That's not what I'm saying. I'm talking about analyzing the business and understanding where you are in the process. And so you need to begin to put a little bit of pressure on your flippers to get rid of those properties so that you don't realize that risk. So if this situation where I lent $300,000. The skin in the game from the flipper is $30,000, and the retail value of the property is about $425,000. Now, we haven't been collecting interest along the way, and so the total interest due at this time, because we're around 7 or 8 months, the total interest due on the property is about $40,000. So if we take the $300,000 that is $300,000 that was the original principal plus the $40,000 that's interest, when in an asset that's worth approximately $425,000, my money itself is secure. I am in a secure situation. The issue, though, becomes that the flipper is now becoming into a more precarious situation for themselves. And if you in a business relationship, it's important that you keep an eye on what is going on with your partner. So if I'm lend $300,000, but the flipper is in for $30,000 additional and they owe $40,000 of interest, now they're in the property for $370,000. And the property is only worth $425,000. So when they go to sell the property, it generally costs about 10% to sell a property. It's going to be that now that flipper is into the property for $370,000, and by the time they sell it at $425,000 and pay all the fees associated with selling the property, which is about 10%, they are in for a total of $385,000 is about what they would take, which is only a $15,000 profit, which is very frustrating for someone who's run a project that has run longer and has had a lot of work done to it. And so the flipper wants to hold on to that property because they don't want to only get a small return on the money. You, as the lender, need to take charge in these situations, and you need to explain to your borrower that their property, that the loan is in default and they need to accept a lower amount so they can move it off their books. Their tendency is to try to wait for the highest price. They're only looking at one side of the ledger. You, as the lender, it's your money. You're the one who has to be responsible from it. I encourage you to put that pressure on your borrower to lower the price of that property so that it gets moved off their books. And you have to translate to that borrower that it is better for them to break even on a project than maybe lose a little bit of money. And this gets back to, it's so important that your borrowers have skin in the game, that you're giving them a reason not to walk away. Now, this borrower that I've lent the money to, I feel very confident in the borrower. I feel very good that they are going to resolve this situation. But as a person who's running a business, it's important for me to be watching out for those things. I will tell you the one adjustment that I am likely going to start making solely based on what I see happening in the market. And that is, traditionally, for administrative reasons, I don't necessarily require my borrowers to make monthly payments. I'm seriously thinking about changing that strategy in today's market until we figure out what is going to happen in the United States real estate market. We have lots of fights going on between Trump and Powell and interest rates, and will the inventory be unlocked, and nobody really knows. And so we are in a point of uncertainty. And when we are in a point of uncertainty, it is important that you limit your risks and you make sure that you are safe and that your lazy money is safe and that everybody can be profitable. That includes you, the lender, and the borrower. My name is Rich Lennon. We talk about ways to lend our money, how to be responsible with it, how to grow our money at richlennon.com. If you're interested in what I do, download the Smarter Wealth Blueprint. And if you are still interested in, hit that button and do a growth call. And I'm happy to chat with you about lending money. All right. Hope everybody's having a great day.